Welcome everyone to another Robinland podcast. Today we have episode 4 where we discuss the yield crisis of DeFi. Joining in on the discussion is our marketing director Jack, Alex from Velodrome, and Diego, a DeFi analyst. If you'd like to catch one of these events live, be sure to follow us on Twitter at RobinlandIO. Now sit back and enjoy the show.
All right, we can start kicking things off. So we're gathered this Twitter space to discuss something that we've. All right, we can start kicking. Okay, apologize for getting some echo there. So we're kicking things off to discuss the idea of what Robinland has been calling the yield crisis, which is, I think, now a broadly acknowledged phenomenon where yields in DeFi, which have for a while now been much higher than equivalent low risk finance, have now, following a series of deleveraging, experienced a precipitous decline to the point where it's they've gotten well below now even basic, highly low risk or risk-free yields in traditional finance. For instance, in many cases, yields on curve are returning less than treasury yields, in which is a highly problematic phenomenon for DeFi. So we're here to talk about what that means for DeFi and ways that we could potentially go forward from it, which can include real world assets, which can include new ways of generating activity and benefiting from that and translating that to yield, and potentially even a little bit more of the same, but with some nice bells and whistles. With me to discuss this are Alex Cutler of Velodrome and Sugiyomi, a thoughtful DeFi. Maybe we can start by some introductions. What we do in DeFi, what's been animating us in this space. Let's start with Alex.
Hey, I'm Alex. I am a colleague of Jack's as part of Velodrome Finance in the optimism ecosystem. And what's been animating me as of late, it is really just diving into this whole idea of L222. Starting a protocol from scratch with Jack and with a team of others, launching on Optimism, sort of in one of the sort of toughest series of weeks that we've seen in a long time, and sort of battling through that, getting out on the other side. And of course, the purpose of Velodrome is tied in, I think, to the topic of this conversation, which is building deep liquidity on ecosystem pairs so that the optimism ecosystem can grow and thrive. So yeah, that is me.
Cool. And then Sugiyomi, tell us about your journey through crypto.
Well, in Q4 of 2019, and it was as an observer. I was looking for an investment for the long term, and I knew about Ethereum, and from that point, I started my journey. DeFi. DeFi caught my attention because I've always hated banks. Since the moment I opened my first saving accounts several years ago, I always encountered a barrier with the central traditional finance system. And when I discovered that crypto was working on that, I just got seduced and I started digging very, very deep about the understanding of how is this DeFi system building those blocks. What are the strengths? Where are the yeah? That's my main motivation. It's a it's a an experiment happening in real time, and being part of that, it really likes me so much.
I think it's fantastic, and it leads to an interesting question where you want to be able to exist in a parallel infrastructure to what has what previously existed in traditional finance, and for a while that's actually been a better deal. But now we're getting to a place where, in some respects, there's not so much, not quite as much juice to squeeze as there's in traditional finance, and now we're trying to find some interesting ways out of it. So definitely going to be keen to hear your thoughts on where we could potentially go. At this point, I'll introduce myself. My name's Jack. I'm an anonymous DeFi. I am, as Alex mentioned, a colleague of his at Velodrome, a protocol that intends to be the center of liquidity on the Optimism Layer 2 on Ethereum. In addition, I am part of the team at Robinland in Citus, in which capacity I'm here today. Robinland, for people who aren't familiar, is part of what people are calling BridgeFi, protocols and companies that are attempting to find build infrastructure bridging traditional finance and on-chain finance and DeFi. Some examples of that are Goldfinch. I mean, any ways to offer kind of lending or tokenization in ways that allow people on chain to access the real world. In the particular case of Robinland, it is about using on-chain liquidity to provide lending to state. Using a highly regulatory compliant type of infrastructure. It's one of the ways we're going to propose for crypto to get past what might be a pretty protracted series of yield issues that we're currently facing. So I think maybe where we can start is by I see stuff that Scarlett Chen, who's the founder of Robinland, posted about DeFi, about this particular rate, and what she basically shows is a pretty stark image, which is the Curve 3 pool yield trending towards zero basically over the last several months, and the U.S. 1-year Treasury bill going somewhere between Sphere and Saturn in the last couple months. So I'm curious. Maybe I'll start with Alex. I mean, what have you seen? I guess what have you seen as part of different protocols' concerns regarding yield, or different users' concerns regarding yield, and how are you thinking about the current state of things in your role at Velodrome?
Yeah, sure. I would say that I've seen is just an abundance of caution, and I think we're seeing that both on the side of liquidity providers. I think people are very careful, even when it comes to quote unquote, stable yields, about where they will deposit and where they will farm. in the launch of Velodrome, even though we launched during some pretty crazy months, we have consistently held excellent yields, at least by the last few years standards on stable coin pairs, yields that traditionally would attract, I think, a great deal of liquidity providers very quickly to them. But I think we've seen people be far more sort of careful and reluctant. And I have to believe part of what's driving that is of course the Terra Luna breakdown, the general macro experience. We also just went through a series of months where every other day something was getting exploited. So I think there's just a lot of fear out there. But I think they're probably also sort of like looking at the rewards that they're earning, and it's really hard right now, I think, to get people to see value in a new token. And I think the same for protocols. I mean, protocols remain equally as hungry or dependent on the need for liquidity, but equally sort of sheepish about bribing in the way that they were maybe once bribing, or investing in incentives in the way that they were once investing. I think they are also very cautious about smart contract risk and what they're doing with protocol owned liquidity. And so it just feels like we're in this moment where, it wasn't that long ago, you could just pop up a new protocol, blast some big yields, and, have the entire DeFi world just flow into you. And now it's like you can do all that work, and then there's a ton more work to do after that to like convince people, reassure people, communicate to people. And I think that's like what we've been feeling a ton on the Velodrome side of things, riding through these super choppy waters. But I mean, overall, I think our thesis is that there will still be a few pockets of DeFi that ride through this very, very tough period, and hopefully it does remain. Who knows what total TVL and DeFi will look like over the next year or so, but the hope is that the money that does remain concentrates in a few places, a few emergent ecosystems, the ones that are going to be primed to explode, hopefully, once we come out of the other side of this. But I think it's going to take a lot of work. Can't just build a perfect thing and expect it all to come to you in the way maybe it once would have.
It's really interesting, the notion that it used to be that money was essentially everywhere, and it didn't really take too much to get liquidity. I mean, I remember the times where you'd be hanging around different Telegram chats. Someone would just kind of post some sort of eye-popping yield, and then before you knew it, the TVL would rocket up. That's a phenomenon we obviously experienced in VDAO, but it was happening well before then. These kind of nothing protocols getting a preposterous amount of money. Now we're in a place where you have to convince people that what you're doing is safe, which is probably the correct baseline. But it's also it also means that you have to convince people that your protocol or your vertical, in the case of certain emerging asset classes, is worth their time. I'm curious, Sugiyomi, what's your take on what it's going to take to get that sort of interest, and what sorts of areas do you think could be those pockets of liquidity that Alex is describing?
Well, this yield crisis, I see it under three perspectives, and probably that helps me to answer that question. The one perspective is macro global economic conditions, and I'm going to leave that out of the table because that's a huge discussion, but definitely is impacting crypto. The second is crypto itself. This year crisis, um, yes, Terraform Labs and all what happened with Luna Foundation got and these funds that subsequently enter into a liquidation process, it's very particular in crypto. And that's the second point to answer that question. The third one is the mentality, the mindset of the users of DeFi, because you mentioned something very interesting. There's these catchy APYs, APRs, and if you combine those APYs and APRs with the mindset of retail users thinking of getting rich overnight, it's unfortunately a perfect match. And this, what I'm going to say, it's probably an unpopular opinion, but I believe that for the sad part, the wrong part, we have had somehow a product market fit in DeFi. It's just that it's the wrong product and the wrong market with the wrong fit, because some, let's say, protocols with not uh, think of the long term, that are not building for the long term, are giving these users what they came for. They are giving these users high yields, a promise to get rich overnight, despite it doesn't happen. So unfortunately, from my point of view, there has been a wrong market fit product, just in the wrong way. Just satisfying a retail to get rich as quick as possible. But what we have seen, especially in the last 2 months, since the first week of May, when all these Terraform Labs and Luna Foundation got exploited, is that currently DeFi does not have a sustainable structure to provide yield. And that has been solved during a year since DeFi 2.0 started. So DeFi requires liquidity. And the question is, who has provided that liquidity in the last year and a half? And under which conditions was that liquidity provided? It was during a bull run. So it was easy to provide money and receive some money. But since December and January this year, things changed completely. This is your question. What does it need to convince people, to convince users, investors, not only users, not only retail investors, that this is DeFi is not over, is to create tokenomics that are sustainable in time. And that's an obvious, that's an obvious answer. But we also need to somehow educate people in finance and economics to really understand where are they putting their money, how the money is used, how that money earns yield, and how that yield and how much of that yield really comes back to them. So education is first for users, for retail, but also the design of the economics of the protocols needs to be very, very, very thoughtful. Otherwise, it's not going to work. We can't bring back New York and retain investors if we keep building the same wrong protocols, the same fake yield, the same fake money.
I think what I love about that response is that there's an understanding that there's clearly a mismatch between people's expectations and the sort of product that they're being offered time and time again. A lot of retail users. So we'll focus on them for the moment. That a lot of retail users are in crypto because they've been promised easy money or very fast money. The idea that they could get rich quickly. Do you believe that that retail users expecting solid returns, not life changing, but good returns, could be convinced to go on chain? And what sorts of conditions would have to be met in order for them to do so?
Yes, I do believe that reasonable returns can attract users if we can teach them how this works. If we can cut that myth that crypto is what YouTubers sell, we can work very, very good on that. And what was the second part of the question? Sorry.
Oh, sorry. Yeah. How can we convince them? How can crypto collectively convince these people to move a lot of their funds on chain, to receive respectable, if not eye-popping yields?
For savvy investors and people who are not part of crypto yet, I think the most important thing right now, and I'm talking from a retail perspective, is what you and also Alex mentioned, the confidence that they are not going to lose their money, that this is not a V2 of Anchor or whatever protocol that has fallen to zero in the last 3 months. I think we need to prove that this is not a Ponzi. That we are experimenting, yes. That we need to experiment, yes. And it's going to create a solid, decentralized financial system. Yes, it's going to take years, but they can be onboarded. Not with the promise, because we cannot promise anything, but with some certainty that they are not going to be rocked in the first month. So the project needs to prove that it's serious, and sometimes this happens when it's backed by investors, by other good investors.
When you frame it like that, it really seems like a low bar. It's basically tell the users where they're going to be getting their money, and then don't lose all of the users' money in the first month, which I think is good advice, considering that actually is in some respects the place that we're at. I also think it's a little bit hilarious that I don't know why Bancor always seems to be the example in these kinds of things. They really can't seem to get a good shake. I think this is really I think sound advice, and speaks to some of the verticals that we've been playing in, as in my head as a player in Robinland and real world assets, which do promise an actual origin of yields, and then something like Velodrome, which promises an origin of yields, albeit from a different place. In this case, it being mere users, essentially, users and protocols on a certain layer trying to get liquidity. I mean, Alex, what's your take on this particular view that that transparency is important, that maybe there is a route to using that sort of messaging, onboard those users who may not be, necessarily like chasing the 1,000 extra turns.
Yeah, I thought that was a super interesting point because, of course, transparency is supposed to be one of the principal elements of DeFi and crypto, right? We're supposed to have far more insight into where the money's coming from, how it's being moved around. Contracts as code that enforce the rules versus, murky people and institutions. And I think there's been, projects and pockets of DeFi that certainly are trying to live up to that. But the bursting of the bubble also maybe just illuminated for us just how far we have to go there, or that maybe like in the bull market, how much we forgot about how important those things were, right? And it was just an eye-popping number on a website that was sufficient, and nobody was really taking the time to think about, well, what is actually driving value to this token, or what is the sort of investment structure or team composition, or all those sorts of things that should that are supporting these yields, right? And now, as we've been talking about, maybe a bit more sheepish or careful, but it does seem like, and we're experiencing this every day, because I think people are running us through these far more cautious filters. But we have to really truly explain things like, we don't have any VC investment. There's no sort of hidden hand behind what we are doing. How do we create value? It's very simple, right? It's we generate fees and bribes. 100% of them accrue to the token when it's locked. We will have longevity and sustainability and be profitable as long as the ecosystem around us grows and protocols and projects use us. It can seem complicated at face value, but really I think the value proposition is fairly straightforward. And I imagine maybe in this sort of or this moment of all of us taking a step back, it's probably going to be more projects like that have a shot of sort of building through the bear and coming out the other side, driving real utility, driving real revenue, versus some of the Ponzi games that we were all playing for a while there. And of course, those are also the kinds of structures and systems that might actually lead to true adoption, right? More mainstream sort of use cases. For us, it would just be as a base layer for any number of different protocols and applications that bring in users. Those users bring in fees. All of that sort of activity sort of runs through our base layer. Starts to all become a little bit more straightforward, perhaps, than some of the craziness we've been through.
Yeah, I mean, I think there's I think that's an interesting way to frame it. We are in the midst of this this, I don't know what to call it, like a backlash period, like a refractory period, where there's a lot of skepticism, and in many ways justified skepticism at the sorts of kind of endogenous yield, whose origin you can't really quite put a finger on. And I think on the in the okay, well, I don't want my yield in the native token, I want my yield in ETH. but then you have to look back to where the ETH yield is coming from, and then you see that it's this particular type of activity. Oh wait, but that activity might actually be the result of wash trading, being brought about by the investors of the protocol. And then all of a sudden you realize that there's, like as soon as you look at the second layer, there's even now a new level of skepticism. Okay, so then you go to, then you start looking elsewhere, right? You say, okay, well, there's something like where you say, okay, actually the result of clear fees, it is, it's an honest protocol. There's no one really backing them up. But even then though, right, it's like they live and die by the amount of activity that happens on chain. And I think now that we've kind of muscled our way through this, I think like kind of like the early stages where people weren't really sure whether we were going to make it, you can actually see how confidence begets confidence, and you're able to move up. The third, I think, is the one where you actually try to kind of, you source the yield the way that like an enthusiastic diner tries to source, kind of like the animals they're eating or the plants they're eating, where you say like, okay, here's the direct line from, to the original value. And that's kind of where real world assets come in. I want to just talk about this for a moment, but before I do, there's been an interesting phenomenon in crypto where there actually has been a strategic advantage to obfuscation. If you look at stablecoins, for example, it's a highly adversarial environment where if you have a stablecoin, players know that there's that stablecoin has to be backed by some amount of collateral, and that if it's like a, kind of like a collateral mint type of stable coin distinguished, then you have to mint more stables, and then you can easily lead into this like kind of this destructive cycle. And you see that happening like over and over and over again with these algo stables. By contrast, so this is a case where full transparency actually leads to instability in your protocol, even if you've kind of listened to and followed all the core tenets of DeFi. Compare that with something like Tether, where there's this notion being ignorant about how much collateral they have discourages adversarial play, because no one knows just how much they're backstopped. To an extent that was the case with Luna and UST, where there was this implied backstop, which ultimately got kind of tested beyond its means. But there's something really robust in that structure, if not complete. I think what's interesting about real world assets, however, is that this is one of those cases where that type of transparency doesn't have to be a weakness. And I think that can be the case with all yield, not even necessarily real world assets, but all yield, whose origin is something that can be understood to be relatively independent of manipulation or overall market activity. And that's something for me that's in real world assets is kind of a clear example of that. And that's the foundation of this as a potential means to kind of get out of that type of skepticism, which it seems we agree seems in part to be animating this continued drop in yields. That is, lack of confidence leads to less liquidity in, which leads to less demand for leverage, which leads to lower yields. And I think there's probably something to that within DeFi. I'm not, it's like of all the different ways that that activity or demand can breed that sort of yield, and I almost don't know that there's been a full accounting of that. I think the last thing I'll say, at least as far as real access is concerned, on this point, is that this sort of transparency, I think, can be really engaging for users. I think most of the time it's actually probably too much in a way that really has turned off users. And now once we're getting into, for instance, like regulation and all the other things that you have to interact with once you're dealing with the real world, I think that's made it a bit too weird in a way for DeFi users, at least. And so I'm wondering whether this sort of period, to kind of circle back, whether this sort of period might actually lead people to try to find something else. I'm curious. So I'll kind of turn this back around on the two of you. I mean, how do you envision like the appetite for transparency, or at least kind of a potential shift in the culture of crypto evolving? I mean, there are people who probably won't accept this type of distinction in scope. How do you who is the user that you have in mind entering these new sorts of experimental protocols?
I think the type of users I envision these kind of users more educated about what Alex mentioned, is how the protocol accrues value, not only in yield, but how the protocol provides value for the long term of DeFi. And I envision also a user probably more traditional finance world, probably with a background from the traditional finance world, because it's for them, for those users that are somehow transitioning from traditional finance to decentralized finance, is a very good opportunity to match what they know, where they have been maybe successful, or at least they have the understanding of how it works, see it in crypto, removing all the limitations that traditional finance has. So I think it's a good opportunity, and for new users, new retail users, it also provides somehow peace about risk and all the liquidations and the bad practices we have seen in the last 4, 5, 6 months. So it's a good match. I think the nature of the mindset of people in crypto is experimentation, and this is a good moment. Or maybe this real world assets is a good proposal, a solid proposal to start perhaps a better experiment than the Ponzi games we have been seeing in the last month. So I think it's a good opportunity to more security, and that's something that might provide certainty for savvy and non-savvy investors.
Can I ask you a quick question? Do you, given your skepticism about banks and a lot of the traditional finance system, would you invest in U.S. government treasuries if they were offered on chain?
Yes, and let me tell you why, because I'll try to do it with an analogy. Uh, most of us, most of retail, somehow have a connection with, well, maybe not most, but a good percentage of retail investors in DeFi have somehow experience with the traditional finance system. And we know the limitations, we know the constraints. But this part that we don't like in crypto is what has kept us somehow safe in the traditional finance system. Introducing real world assets, it's also a door, it's also an open door to some extent of regulation. So enjoying or investing in all the advantages that crypto has with maybe some sort of regulation adapted to tokenized assets would give me some certainty to adopt this new experiment. And I go back to one of the three perspectives I mentioned at the beginning. The mindset for the users needs to be changed. This is not a quick Ponzi game where you make money overnight. This is a long-term investment. Not only receiving money itself, but also supporting a complete changing environment. I mean, I'm very optimistic about crypto, and I don't know, 5, 10 years from now, we can set strong blocks to completely change the world we live right now. So if we can somehow start to put that mindset in these new investors, and the world they come from, which is the real world, and make somehow a bridge to crypto with these real world assets, we might have a better onboarding and a long-term investing mindset for new users.
Yeah, that's so interesting because Jack, how I was going to answer your question immediately, sort of like who's going to be interested in it, who's going to leave out. You know, my idea was, I think maybe more grown-ups will be interested in it. You know, people who are actually interested in building this. Building a crypto future and a crypto future that certainly interacts probably more with the real world, right? A crypto future that has some relationship with regulation and with some more safety. You know, I think maybe who it leaves behind is a certain segment of the crypto population that doesn't really see this stuff in terms of the potential paradigm shift for finance and, you know, access to capital and, you know, flow of money across borders, but just see this as a PvP game that they play to take as much money as they can, you know, from whoever will give it, right? And in some ways, it might be a bit of a maturation of the system in ways that, as a whole, right, will of course make crypto and DeFi, you know, far more successful than, or I should just say, maybe bigger, right, more valuable, more impactful than it is now. But it might look and feel a little bit different than the thing that we've gotten used to, and that I think attracts a certain type of DeFi and crypto user. So there will no doubt be tension in that, right?
I think this is in my view clearly the big get, is the that next step of investors who are the grown-ups who know that they can deploy um, all this juicy boomer money and find themselves you know finding themselves more efficient means of managing and allocating their money. I'd like to. I see that Carnation, a friend of I guess all DAOs, is here, and I was hoping to invite up to offer. I don't want to presume counterpoint, but certainly a point on this topic.
Yeah, hi. When I joined, the question sort of cut out. Do you mind repeating it?
Of course. The question is, I guess the premise is, okay, so given that yields are in the toilet right now, we're trying to explore new means of generating yield, or at least finding showing enough safety for people to want to allocate their money again, either whether it be through assets, kind of moving away from kind of native pool to Ponzi toward more fee based or kind of external, like store of value token based yield. And the question is, would this does this attract a new type of user? Would this user, if this is like a fundamentally different user than a degen, will they come? Will they come? Then also, would you invest in Fedcoin?
Yeah. So I tend to ramble a little bit, so feel free to cut me off. But purely on-chain, like we cannot create dollars in a way, right? So when we collect fees from all these various apps, whether they're DEXs, lending protocols, or other things, then it's like somebody is on sort of the losing side for that. And not necessarily like they lost value, but like somebody wanted to gain exposure to a certain token, so they did a swap. Somebody else wanted to perform, they borrowed something and short sold it or something like that. Like there is value being created for people, but like in a way, it's still very zero sum. And I think personally that by bringing yield from off chain things, we give people exposure to basically some things external to the system. And in a way, it becomes a little less zero sum. And yeah, like real world assets is definitely a very good one. I suppose the other one that people even now pay access to get access to is the stock market itself, right? Because if you go through any TradFi brokerage system, you either pay to trade or you have to pay portfolio management fees or other things. So like people desperately want exposure to the upside of, I guess, like society's economic growth. And yeah, like they are paying like pretty hefty fees to enter and exit positions and management fees and all that. So yeah, like that's something that I'm hoping that would come on chain, although like stocks are very regulated as they should be. But yeah, hydro asset is a very good entry point for I guess like related sort of off-chain yield to come on-chain. Yeah, and I think maybe to the point of attracting a different type of people other than degens, I think you can roughly divide it into two classes, although like it's definitely not like clear cut. There are people who want passive stable yield. They denominate in USD or their local currency, and they just want to park that somewhere so that they can basically account. Like they don't necessarily want or like are imagining like 100% APYs, but they do want to like have a meaningful amount so that when they bridge on and bridge off, they've made some interest in between. And there are also definitely the speculators. They look at all the things in DeFi, and they want to take a more equity sort of stance on this, where they want to buy ownership in all these different protocols that are generating some sort of value on chain. So yeah, like however you want to take this next.
I guess I'd want to ask, is there a way for this sort of structure to appeal to degens as well? And what would it take?
Leverage. I know we've all seen a little bit of fallout and gotten a little bit PTSD from certain people in the space taking on way too much leverage. But leverage in itself isn't a thing of evil. So even if or just as in the traditional bond markets, and also like foreign exchange traders, like they take on massive amounts of leverage because the movements in the underlying are so tiny. So like even though they're levered hugely, like typically their risk, absolute risk is still quite low. And on our side, I think how we can turn some of these products into a little bit of more degen type things is that if we have like assets tied to real world yield, we can lever it up a few and senior tranches, which is like a very common technique, so that the people who still want a protected but fixed low yield can do that. And for the people who are okay, like either being slashed or being penalized or not getting all of their principal back, they can take on the usually like several multiples higher variable yield. And yeah, like in that system, there are some things I've seen. I think I don't remember if it's Maple or Goldfinch. Their variable tranche is actually like 5 times higher yield than the senior tranche, which brings it to a level where it becomes like extremely degen, right? Like we're talking 30, 40, 50% APY on stable coins, except, you know, if the people don't pay you back, you're on the hook.
That makes a ton of sense. I would imagine that that a lot of this presumes existing outside of regulatory structures. Do you think they're tight for KYC interaction in this type of structure?
Yeah. So there was an interesting conversation I had with someone who's trying to onboard institutions into DeFi, and it's that for a lot of institutions, for them to jump through all the different regulatory hoops on their side and making sure like legal regulation, KYC, all that is done properly, they aren't looking for any opportunities, you know, like below 9 figures essentially. Like when they come with extreme size because of like how much issues there are. But once they find these opportunities, like you know, like if we tell them that, hey, like there are these different things, here are the risk profiles, reward profiles, and you can come in with like, you know, 9 figures plus size, then they are very interested and very motivated to like study this well and like yeah, like prepare themselves to come in. But the I guess the limitation of that is things that are strictly on chain right now. None of them are that size without like all sorts of issues, whether that's like diluting your own yield or suffering horrible slippage or things like that. So like the closest thing that comes to mind is like staking a native token and more or less just ETH for now. Even the other L1s, you couldn't put on too much size. And yeah, like where real world assets really comes in is because the real world is very, very big. You have to move like tremendous to like move the markets out there. So by, I guess, using the blockchain as a system to just like yeah, like secure and also like enforce various like real world asset trade agreements, like that could be, yeah, a very, very major source of income, basically routing like real world money into, well, onto the chains. Yeah.
And most onboarding kind of occurring from, kind of at, I guess, beginning with that level of size. Do you envision kind of like the modal average, like CT adjacent degen, like entering into these types of structures as well, or is this kind of like it's necessarily led by the large players?
Yeah, so I'm not like I don't have too many examples to give here. I think maybe like more on lines of the institutions that are interested in staking Ethereum. Like some of them, depending on their own regulations, they have to only touch KYC funds. So and also like staking only with KYC staking providers, which means that the ETH they acquire must be from again like KYC counterparties, and they have to fill like a bunch of uh, compliance forms and also like collect data on their operator. Let's say like um, they sort of work in this bubble that's isolated from um, retail or basically everyone else, the degens essentially, simply because they have to like they can't take money from the degens to that staking. And where I'm going with that thought is like probably most likely what's going to happen is this will be the type of structure in place where the institutions that are running some sort of trade or operation inside, they're like ETH staking, or for example, like AVAX gave some good examples of enterprises that might be wanting to run their own KYC subnets. Like we'll probably see these little bubbles pop up here and there. Like everyone's still running using the same validators. We may be like running the contracts, taking up the block space on the same chains, but essentially these people, the contracts they interact with, the source of their funds are all super like rigid and basically like whitelisted such that like nobody else can participate, and not necessarily like for better or for worse. It's just yeah, for those players to enter the game at all, that's the rules they have to follow.
That's super interesting, and it makes sense that I mean it's interesting to know that the ball's already been rolling in that direction. It would suggest that there aren't quite so many barriers that would have to be to really, I think, play out at scale. I'm curious though. I mean, Alex Suki, I mean, would you? I mean, Alex, you're functionally doxed, I guess. Not to like double dox you, but I mean, would you? How would you? I mean, would you take all of your finances and bring them on chain, which would and kind of KYC through that whole process? How do you? I mean, not to kind of go from big, kind of like big to retail, but I'm curious, like about just how much of the, how much of the pool, so to speak, could go into something like security tokens, and KYC and go through all of the hoops for that.
Yeah, well, I mean, I'm already crazy enough that pretty much I've moved everything on chain. Although I think just the general moment has put me where a lot of people are, which is mostly in stables trying to figure out what I'm going to do, next. And I do think to what we're discussing here, that like I'm going to be looking for things that feel a lot safer, right? At least for the bulk of where I'll put my money until I develop new theses or ideas that I want to lean in really hard with any major percentage of my holdings. I like the optionality, right? I mean, I think ideally, if this whole ecosystem, this DeFi ecosystem, is going to be something that is massively appealing, it has to give that kind of security and optionality to anybody who does want to live their financial life, right, entirely on chain, and to move between, maybe some more risky assets and things that are, way more tied to real world or institute to require, more verification and doxing, and that would be, of course, a sign that the system has really made it when you have that like full suite of options. You can embrace that full range of risk in how you're approaching your own investing.
Yeah, I love that. I mean, I hope that's that's good, because that to me, what you're describing is I think that crypto needs that mentality in order to carry it. I think through this particular stage, an openness to the new sorts of opportunities that are opening up. I'd like to ask Tsukiyomi to lend their thoughts as well, and then I think just making sure that that I'm respectful of everyone's time. We can then open it up to a few.
Sure, I'll be quick. For my portfolio, I have in crypto like 65-70%, and I kept around 30% in precisely real world assets investments, mainly in real estate. And I decided to do it that way because before starting crypto, I knew how real estate kind of knew how it worked, and I decided to keep that investment to see the evolution and to compare it with my investment in crypto, and a lot of insights about that comparison, uh, but still prefer to keep it split because crypto, I love it. I believe in crypto. I'm pro crypto, but still needs the evolution to get that certainty to move 100% inside. And as a retail. And about the KYC, well, I love anonymity, but no problem at all to KYC for a certain amount of my portfolio. If I have the other advantages of KYC. From my perspective, no problem at all with certain part of my portfolio.
I'll admit that's not that's really cool. I think on several fronts. First, the ready engagement actively in real world assets, and then secondarily, the interest in being able to in submitting to those sorts of kind of regulatory structures in order to reaccess those types of assets. I think that bodes well for this new wave of BridgeFi. Whether that be on the security token side, like Robinland, or on the kind of more of like Citus, and we can share for those new to that links to our discords. Definitely recommend engaging there. For the moment, though, I mean, happy to. I think we can answer a couple of questions. Would like to remind my people here that you can ask stuff to like a yield deity, a founder of a protocol, and like a deeply thoughtful OG in DeFi. Some any thinks this is a pretty cool slate. All right, you got one.
Hey guys, thanks for doing this. This was really great.
All right. Hey there, Gambit. It sounds like you're connecting.
Yep. Can you hear me?
Yeah.
Cool. Yeah. So once again, this was really great. Thanks for doing this. I did want to ask about on the topic of real world assets. For the longest time, I've been sort of waiting for a token like an on-chain version of the S&P 500. Sort of as my flat position as opposed to just sticking to cash or something. And so I'm always kind of curious, like why is it taking, why isn't, why don't we see adoption in that quite yet? Is it just purely regulatory or are there other reasons?
Before I take a shot, does anyone have availability or any of the roadblocks? For some speculation and a little bit of knowledge. Okay, so I think you've got me. So I think there are certainly protocols that intend to do this. I mean, I think like perpetual protocol is one that comes to mind, where the idea would be that they mint synthetic assets that reflect using oracles to different real world assets, and this is something that I've wanted desperately for the longest time. I think similarly to you. My understanding is that it has to do with that there are questions about kind of I think like regulatory issues where they're still trying to get their footing as protocols in the first place. I think there's questions about kind of building and like I guess like the actual kind of construction of these sorts of infrastructure required to provide the price information. Like I imagine it's not the easiest thing to be able to do, even with some nicer oracles. Like I know for instance, Pith was supposed to be the gold standard of oracles on Solana, and they were facing some pretty enormous issues fairly recently. So we might not quite be there yet when it comes to being able to meaningfully and then I think it's just, I mean, my view is that it just has to be like a lack of uptake. Like I think a lot of the players need to come together at the right time in order to get a nice robust liquid market. Maybe a way to think about this is like we're just now starting to see like the EUR the Euro, like versions of I imagine that would in a way be kind of easier to pull off than something like the S&P.
Well, so there was like the Mirror protocol back in Luna, like early 2021, which I was a heavy user of at the time, and it worked pretty great. I think it did get a lot of adoption at the time, but then Do got slapped with like a subpoena or something by the SEC. So it might be some regulatory friction there, but I don't know. Even when you consider non-on-chain S&P sort of like tokens that you can go in, like FTX, for example, they have S&P 500, but it has, I haven't looked into this very closely, but it has very, very low volume, probably 6 figures a day. So it just can't be used either. So kind of like, it's kind of a strange reason why it, it hasn't really taken up yet.
Yeah, that's a weird one considering. Yeah, that's right with Mirror. I mean, there was, and I think there is like this enormous latent interest in it. I remember that I mean, if you were trading on FTX, you probably had some like international account domiciled in one of the good countries, right? Because they had because it was licensed by like some German ETF provider. You couldn't get access to it as as a U.S. citizen, or probably I think like a handful of other countries. So it could have just been that for whatever reason, like the Venn diagram didn't quite work out for them. They're kind of non-crypto markets are generally really weird. Like I've always hoped that they would have, for instance, like more liquid prediction markets, but they never really panned out.
Mm-hmm. I agreed. Yeah, even Kalshi is sort of coming up, but then there's just not a ton of liquidity yet. But I think it's slowly getting there.
It's weird that Alameda wouldn't kind of readily be making markets in that, because that would seem like such an easy prediction markets where they actually have to have something of a view.
Aren't they clearing? They're the clearinghouse, right? FTX is a clearinghouse for Kalshi.
Think so, yeah.
Yeah. Sam's trying to go for like the stock market pivot, and I think it's just such a huge opportunity. A lot of people here, like you guys are talking about buying U.S. Treasuries earlier. Like, yeah, that's a good option, but also just the index. A lot of the best investors just a good chunk of it and just riding the index as opposed to staying in cash. So you're going to just have so much ridiculous demand. And you wouldn't have to choose between BTC or cash.
Yeah, 100%. And doubly so on chain.
Yeah.
Cool. Yeah. Appreciate the thoughts there. I think that's a nice, that's like a nice parallel issue, I think, to the, to the, this all comes back to finding ways to be able to make those sorts of connections on chain. And also the question? Nothing else now. I think we can call it. This was I learned a ton on this, and I'm grateful to everyone for showing up and sharing some thoughts. So as a you can offer for any kind of final closing thoughts, or I can kind of give some directions for if anyone wants to kind of like pitch your projects, pitch stuff that you're writing, or direct people to learn more about this. Now would be the time.
I'll just say thank you. I definitely learned a lot too, and really appreciated the conversation. If anybody doesn't already know about Velodrome, put the plug in. You can click on the little Velodrome icon in the chat here. Come see what Jack and I are up to when we're not talking on Twitter Spaces. But really appreciate you having me on.
Same here, Jack. Thank you so much for providing the space, for listening to our thoughts, and thank you for that.
And thanks again, everyone, for participating and listening. Alex covered the Velodrome. I'm here with Robinland. They're offering one of the, I think, most credible solutions. An amazing team, primarily on the security token side of the tokenization of real estate debt. That is not equity, which is, I think, a more probably the more reasonable way to do this interaction. And then one of their partner protocols, the more DeFi native one called Citus, I would suggest following the Robinland account, through which you can access these different protocols. Robinland, if you want to be able to access through real world means, the Size protocol. If eventually you want to go the way of Carnation and find ways to integrate this into more degen possibilities. There's a lot of ways we can do this. It's a really exciting time, and if we're gonna claw our way out of the zero yield environment that we're currently in, I think this is the way that we save crypto. So, was a great talk. Have a nice evening or morning or wherever you are, and hopefully we'll have another one of these soon.
Thanks.
Thank you.
Bye-bye.
Bye.